The Western U.S. right now is seeing very steep increases in home prices, with home price growth more than 20% in California, Nevada, and Arizona over the last year or so. And we do see that growth continuing in the short term. Really, there's a couple of factors that are driving that home price growth, and we don't see these as long-term factors. Right now, there is very restricted supply and a short-term boom in demand that's really contributing to those rise in prices. So the demand boost is really coming from the beginnings of the turnaround in the market. So as prices started to rise after a trough in 2011, institutional investors jumped into the market in large numbers and purchased up a lot of supply, especially on the low balance end. Individual buyers have also come back into the market after staying on the sidelines in the aftermath of the downturn. And together, they have really reflected a boom in short-term demand. But it's not really something we expect to be a continued force in the market. Despite significant home price growth over much of the country in the last year, Fitch continues to have concerns about the long-term viability of those increases. In order for a healthy housing market to be able to persist and continue to grow, we really expect to see a strong demand base coming from the labor force. And while the economy has continued to improve over the last several years with high numbers of GDP growth and new lows in unemployment numbers, some of those headline numbers actually mask some of the deeper problems that continue to persist in these markets. So while unemployment is now down to 6.7%, off more than 3% from its peak, most of the declines that we've seen in that unemployment rate are actually coming from workers exiting the labor force rather than increase in actual employment. We actually still have fewer jobs today than we had back in 2008. And so that's a long-term concern for us. What it means is that we actually have a shrinking demand base with workers no longer working, no longer being earners. And at the same time, we see median household incomes declining despite rises in GDP. So for your average borrower across the U.S., things are actually still very difficult. And we think it's probably going to be difficult in the future for some time. We still haven't seen many signs of a strong recovery in the broadest of terms. And as we see housing demand over the next, let's say, 5 to 10 years, there's going to be residual softness coming from the effects of decreased net worth, decreased earnings, and really decreased motivation to go out and buy a house. There's a number of markets where we've seen very steep home price growth over the last several years that we're concerned of really increasing overvaluation. Some markets, such as Phoenix or Las Vegas, really were very undervalued after the downturn, and increases of approximately 25% over the last year we really see as pushing prices back toward their long-term averages. In a number of other markets, primarily in California, these increases have really pushed prices above their long-term sustainable levels, despite economies which really are still not that strong. And so in a number of these cities, primarily in coastal California, including San Diego, Los Angeles, Oakland, San Francisco, the growth that we've seen is really in excess of the improvement in underlying economic drivers. It's not so much that we expect to see large decreases in prices, but that the sales we've seen over the last several years are really biased toward a small sample set of properties that are selling at high prices. And as we see more inventory come online, we expect those prices to moderate.